All right, so now we've gone through, we've identified targets, we've prioritized them, we know who we want to reach out to. It looked like there were a lot of people in here who have acquired businesses, so you're probably familiar with term sheets or letters of intent. This is your initial opportunity to sort of memorialize what the potential terms of a transaction might look like, enough that the seller says, yes, it's worth me disclosing additional information to you and distracting my management team from their core activities, and enough for you to do the same. The term sheet tends to address a handful of key issues: transaction structure, asset versus stock deals. What you're going to find generally is that buyers always want to buy assets and sellers always want to sell stock because of a whole host of liability as well as tax issues, which Rich will expand upon in a little bit. The scope of the business to be acquired. A lot of times this is fairly straightforward. You're acquiring an entire business, but sometimes it's not so straightforward. You may be buying a division or a carve-out or something like that where you need to clearly delineate, or you may be buying a business where the seller's insisting on retaining some aspect of the business on an ongoing basis. Often addresses the timing of due diligence and closing. You're not going to get sort of an open-ended window of time to perform due diligence. Recently had a situation in our client base, which I honestly haven't seen in ages, where they were talking to a target, and the target said, hey, this was probably 2 or 3 months ago, they said, yeah, it's fine, November, December, sometime like that. It was open-ended, which we rarely see. It's typically a very short time frame. They want to get you in and get you out, and they don't want the word of the transaction to leak out. Addresses proposed transaction consideration, not just the aggregate value, but the form of that consideration and the timing. So is it going to be cash? Is it going to be stock? Is it going to be a combination? Are they going to get it all day one? Or are they going to get some of it in the form of an earn-out down the line? Confidentiality provisions, which are usually a critical element. Again, what we typically see, and I don't know if any of you have had a different experience, is that the sellers just don't want to share or provide you with access to customers, to vendors, or employees because they don't want word to leak out about the transaction and damage their business. The only other thing that I want to talk about is we don't see these issues as much in our client base. You can have term sheets that are binding or non-binding and exclusive or non-exclusive. In terms of binding, it's exactly what it sounds like. You submit a binding offer, you have to close. We don't see that, I'd say, often, if at all, in our client base. Typically what we see is a non-binding arrangement where you make an offer subject to due diligence and you have the ability to walk away if you decide that it's not something that you want to pursue. The other thing, though, to be aware of is in terms of exclusivity, obviously your motivation is going to be to try to make sure that they don't talk to anybody else during the due diligence phase. You don't want to invest all that time and energy only to have them walk away and sell to somebody else who came in out of the blue and offered a higher purchase price. Most of our clients, again, are successful in doing that. One thing to be aware of, if you're dealing with a seller that has investors that aren't actively involved in the business, sometimes you'll see the board step in and say, at the end of the day, we have to act in the best interest of our shareholders, and we need to make sure that we have the option of entertaining superior offers if they come in on an unsolicited basis. Again, if they haven't gone through an auction process, sometimes it's difficult to demonstrate that you've done everything you can to maximize value for your shareholders. So locking on to one potential acquirer without an out increases risk of litigation. This is something that, again, I've only seen a couple of times, but it has come up where a seller said, look, we're going to insist on the ability to entertain another offer as long as it came in on an unsolicited basis and it was a higher offer than your offer.